Here's the core mystery we literally face in business every single day. Your company's cash book says you've got one amount in the bank. But then, you look at the bank passbook, the statement straight from the bank itself, and it shows a completely different number. So you gotta ask, which one is lying? Well, usually neither of them are. They're just experiencing a kind of temporary disagreement. Our job today is to find out exactly why and force them to make sense.
Okay, let's dive right into this. Here is our syllabus for today's review. First, the tale of two balances, then causes of balance differences, followed by timing delays and errors. After that, an example comparing the cash and passbook, then steps to resolve differences, and finally, a summary and final review.
Section 1. The Tale of Two Balances.
All right, before we kick off this investigation, let's just quickly lock in the foundational theory. To reconcile literally means to identify the difference between two different sources and, well, eliminate it. So a bank reconciliation statement is exactly that. It's a statement reconciling the bank balance as per your cash book with the balance as per the bank's passbook. How? By laying out absolutely every single cause of the difference. It essentially brings the two statements perfectly back in line with each other.
And this brilliantly illustrates a really cool concept that pops up all the time in practice, the mirror rule. You see, the cash book is maintained by you, the business. You treat the bank as a debtor, an asset. So when you deposit money, you debit the cash book. But the passbook, that's maintained by the bank. To the bank, your deposit is actually a liability. They literally owe that money back to you. They treat you as a creditor. So a deposit on their end is a credit. A debit balance in your cash book equals a credit balance in the passbook. They're exact opposites, they just mirror each other.
Section 2. Causes of balance differences.
Our first major realization comes down to, well, sheer mechanics. The way banks process funds naturally creates gaps. Think about it. Whenever we deposit or withdraw money, it has to be recorded in two places. But those two places don't communicate instantly, do they? No way. The gears of the banking system, they take time to turn, and that mechanical lag, that's our first big clue.
Section 3. Timing delays and errors.
Okay, so our first real culprit here is timing differences. Let's say you deposit a check today. Bam, you immediately increased your cash book balance. But the bank, they won't actually credit your passbook until those funds clear a few days later. That delay creates a temporary discrepancy. And the exact same thing happens in reverse. You write a check to a supplier, you deduct it from your cash book right away. But if that supplier just leaves the check sitting in their wallet for 2 weeks, the bank obviously hasn't deducted it yet. These are classic timing differences, where transactions end up recorded in two entirely different periods.
Now, our second set of culprits involves direct bank actions and, let's face it, sheer human error. Sometimes the bank moves money around without you knowing immediately. They might charge account expenses, add interest, or maybe a customer makes a direct deposit. Your passbook updates, but your cash book is completely left in the dark until you actually check the statement. And then, of course, there are errors. You might write down the wrong amount, record a deposit on the payment side by mistake, or just totally mess up the total. The bank rarely makes errors, but humans updating the cash book, we definitely do.
Section 4. Example: cash versus passbook.
Now, what's really interesting about this next piece of evidence is, well, it's a concrete example, the fascinating case of Messrs. Tall and Short from our source material. Looking at their records for the end of January, their cash book shows a debit balance, meaning a positive bank balance, of 237,000 rupees. But their passbook from Punjab National Bank shows a credit balance, which, remember the mirror rule, also means a positive balance of 243,000 rupees. They do not match. We have a 6,000 rupee discrepancy on our hands to solve.
So how do we find exactly where the numbers diverged? It's time for some manual detective work. We literally take the two statements side by side. Again, keeping that mirror rule in mind, we compare the debit entries, the receipts, of the cash book with the credit entries of the passbook, and we just tick off every single item that matches perfectly. Whatever is left unticked, those isolated unmatched entries, bingo, those are our culprits.
For Messrs. Tall and Short, this side-by-side comparison isolates the exact unmatched entries. You'd find, for example, that maybe a check for a certain amount was issued in the cash book but never actually presented to the bank, leaving the bank balance artificially higher. Or maybe the bank charged a fee that hasn't been recorded in the cash book yet. By lining everything up and ticking them off one by one, the specific causes of that 6,000 rupee difference are brought right into the light.
Section 5. Steps to resolve differences.
Now we're shifting from finding the problem to actually solving it,
Here's how this builds a completely foolproof methodology. Step 1. You always pick one balance to start with. Let's say the cash book balance. That automatically makes the passbook your target book. Step 2. Compare entries to find the differences, just like we did with the ticking method. Steps 3 and 4, you adjust your starting balance. You just ask yourself, did this specific difference make my target book higher or lower? If it made the target book higher, you add the amount. If it made the target book lower, you subtract it. Step 5. After adding and subtracting all those little clues, you will magically arrive at the exact balance of the target book. Boom! Case closed.
Now, a slightly tricky detail the source material highlights is that you can actually start this process from any of these 4 specific points: a favorable debit balance or an overdrawn credit balance in the cash book, or a favorable credit balance or an overdrawn debit balance in the passbook. It depends on the exam question, but remember, whichever one you start with, the other book becomes your target.
So the crucial point here is this golden rule of adjustment. You always adjust your starting balance to mimic what happened in the target book. Let me give you a quick example. Say you start with the cash book. Your target is the passbook. A check was issued but not presented. That means you deducted it from your cash book, but the bank hasn't deducted it yet. Therefore, the bank's balance, your target, is higher than yours. To mimic the target, you absolutely must add that check's amount back to your starting balance. If you just faithfully follow the target book, you will literally never get a question wrong.
Section 6. Summary and Final Review.
To sum this all up, the bank reconciliation statement is absolutely one of the most powerful tools in accounting. It perfectly reconciles the cash book and passbook. It highlights any undue, suspicious delays in the clearance of checks. It brings any human errors committed in the cash book right up to the surface so they can be fixed. And ultimately, by incorporating the effect of all those uncleared funds, it reveals the actual true position of the company's bank balance at any given moment.
I want to leave you with this provocative thought. The source text notes that without reconciliation, accountants could misutilize funds temporarily by recording an entry without actually depositing the cash. So, without the BRS acting as a financial detective, how long could errors, delays, or even outright fraud drain a company's funds completely unnoticed? By mastering bank reconciliation, you aren't just doing math, you are protecting the lifeblood of the business. Keep practicing those adjustments, always follow the target book, and I'll catch you in the next explainer.